Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 351 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including inflation concerns, trucking rates, S&P 500 sector weightings, and new Trump IRA accounts. Whether you are tuning in for market insights, planning tips, or just staying informed, there's something here for you. So good morning, Matt.
Morning, Mark. Can you believe it's almost Memorial Day, man?
No, it's crazy. Yeah, it's crazy. And it's at least here in the Dayton region, I think it's going to rain for about 2 weeks straight, which is kind of crazy. So
it's an easy thing for if you're a meteorologist. All you got to say is it's going to rain every day.
It's nuts. I opened the weather app and hoping to take the girls to the pool at least one day this weekend, and it just looks like it's going to rain constantly. So,
I'm with you. Yeah. And what's going to happen is it's going to happen in pool access across Southwest Ohio. That window where everyone can go to the pool, it's going to be packed.
Yeah, it's going to be packed.
And of course, I got tapped on the shoulder this morning by the kids, and they're like, "Dad, let's go to Kings Island this weekend." And I'm like, "I'm in, but you're going to have to find the window gap."
Right.
So it's like you got to find the gap in the weather, and I just don't know if you're going to find it.
Yeah, I can't imagine Kings Island in a downpour would be very fun for a parent.
It is. I'm not saying it's a level of hell, but it is a very displeasurable situation.
Yeah, I would imagine.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Anyways, getting back to it, as always, we will review the month-to-date and year-to-date performance of the major market indices that investors track. This data is from Y-Charts, and as of the market close on May 20th, S&P 500 index up 3.1% so far for the month and up 8.6% for the year. Dow Jones Industrial Average up 0.7% for the month and up 4% on the year. NASDAQ Composite Index up 5.5% for the month and 13% for the year. The Russell 2000 Small Cap Index down 1.8% for the month and up 10.9% for the year. And the Vanguard All World X United States Index Fund is down 0.2% for the month and up 9.8% for the year. 3-month Treasury rate at 3.65%, the 2-year at 4.04%, and the 10-year at 4.57%, which we'll talk about a little bit more here shortly. So,
I mean, if you would have said a five handle on 10 years, I would have not even reacted to that.
Yeah, it wouldn't have been very surprising, and we're actually really not that far away from that. And with the way things are going and the direction things are going, it wouldn't surprise me if we were there sooner rather than later.
Agreed.
Which kind of leads us right into our big headlines and current events for the week. The Treasury market, Matt, and we've been talking about this a little bit the past few weeks, has been making some headlines with yields moving higher and obviously prices moving lower with that inverse rate bond price correlation.
Yep.
And last Friday, the 2-year rose over 4%, the 10-year hit 4.6%, and the 30-year exceeded 5.1%. So, we have really seen since, 2020 and COVID, rates continue this steady climb higher. And I think one thing that's important to point out that most people might not be aware of is interest rates looking all the way back to the inception of markets tend to go through these really, really long-term cycles of we're either in a downtrend in terms of rates or an uptrend in terms of rates. And we really have been in this prolonged period of a downtrend in rates since late 1970s, early 1980s.
Yeah, I mean, they had a period of strength there in the late 90s with the internet boom, right? And the economic strength we had, and it came right back down.
It was short.
It was short.
And if you just pull up a chart of, the 10-year U.S. Treasury, it's been pretty clear that up until 2020, rates have been steadily falling.
Yeah, I mean, you could get mid-double digits in the early 80s,
right?
Late 70s.
And since 2020, there's been a clear shift in the way rates have been acting. And now it looks like we're starting, this next move or next leg higher in rates. I still think it might be a little too early to say this is going to be a rising rate environment for the next 30 or 40 years. But, it definitely has people's attention that, rates might not be going back down to 1 or 2% anytime soon.
Yes.
And I think, in terms of financial planning, people have been waiting for rates to come down even lower to make home buying more attractive. And I think people might be a little surprised if it never gets back to that level. But again, we have not been in the industry or managed money when we've been in a rising rate environment, a long-term rising rate environment, right? And I would argue most people in our industry have not managed money because, like I said, it's really been since the early 1980s where we've had a steady trend of falling rates. So I just think it's going to be really interesting to see how this all pans out, and I'm not ruling out that this could be a fake out and rates roll back over, inflation starts to come back down. But with the way TIPS are acting relative to nominal treasuries, so Treasury inflation protected securities, they are outperforming. They usually outperform during times of inflationary environments, rising rates. You have oil spiking, you have commodities performing really well, and all of that stuff is kind of indicative of us being in a higher rate environment.
I think it's well said. And here's my case on this. There are ways to invest and take advantage of that environment. It's not as if rising rates are a death nail for the stock market, right? And
the bond market might be a different conversation.
Well said. And I think this is important delineation to discuss, because I think you will see, if rates continue higher, tons of clickbait, and everyone's going to come out of the woodwork saying higher rates are going to be the thing that brings the equity markets down. Could it? Yes. And we've talked about the contagion effect of some of these lower interest rate countries like Japan and how that's had the effects on the markets. If you've been a regular podcast listener, we talked about that recently. But my message is, don't sit there and assume automatically that higher rates means the stock market's going to be bad. And in fact, I have a piece that discusses that in a little bit.
Okay, well, we'll save it for then. Next, Nextera Energy and Dominion Energy announced a all-stock merger. This was back on May 18th. Obviously pending approvals, but the combined entity would produce about 7 to 8% of the nation's electricity output. So this could take 12 to 18 months. Not a formal recommendation for or against those two names. Dominion got an initial pop off of the news, but yeah, interesting.
I find it interesting. We're starting to stir the pot again of M&A just in general, M&A being mergers and acquisitions for newer listeners. And, you could see more of this, right? And it tends to be good for the stock market, just in general. It's a generalized statement. I love M&A headlines. It gets people going. It gets me going.
Yeah, I think IPOs are on track to surpass the past several years of companies going public. And it was just announced that SpaceX has filed to go public.
Yeah, I saw that.
At some point later this year. So yeah, a lot of activity going on right now, which we haven't seen quite a bit as much of since really like 2020, right?
Well said.
Lastly, Trump's visit to China was a relative non-event for the markets, and it's at least for right now on the calendar for Xi to come over to the U.S. for a state visit at some point later this year.
Yeah, I think they're talking about September-ish.
Yeah. Moving on to tweets, articles, and research from this week. The first thing I had was a post on X from James Lavish on May 13th. Jenna will put this up on the YouTube video. It'll be in our show notes. But what he posted, Matt, was a chart of U.S. inflation comparing the 1970s to today. And usually I don't love these types of charts because I think it's easy for people to manipulate them and try to overfit saying, hey, this is what happened 30 years ago. This is what's going to happen
Find a certain
now.
data set that fits the narrative.
I just thought it was really interesting how closely this inflation cycle is mirroring the 1970s, where people thought, in 1974, 75, the worst of inflation was over because it came down for a couple of years and then it ramped right back up a couple of years later. And I don't want to rehash everything that I just talked about with rates a couple moments ago, but everything I just said is leading me to believe that this is a potential scenario that could play out where we could get another few years of heightened inflation.
That is extremely well said. And if you even dig just a tad bit deeper, the reason was cornered with oil was one of the primary reasons for that secondary spike in what's happening right now.
Oil spiking.
So that's the concern and the credence that this type of data set provides. And if you are a market participant right now, the solace you have to help you sleep better at night is the motivation of politicians. What do politicians love? They love to get reelected.
Yeah.
And let's just call it for what it is. This is a bipartisan statement. If oil prices are sustained going into the midterms, the incumbent is not going to be helped by that data.
No.
That's a fact, Jack. We got to bring that back. There's certain terms, Mark, we got to bring back. And I'm bringing that one back.
Okay.
That's a fact, Jack.
Yeah, I think that it's no secret that the U.S. has strategic reserves if they need to tap into, which I have no doubt the administration would if we're kind of in the same environment we are right now with gas prices.
Sure.
Because that's like the biggest talking point, especially amongst like the older crowd. Like I was home visiting some family and stuff, and some older members in the family, like I heard the topic of conversation of gas prices come up like a million times when I was home, right?
It's the new weather.
Yeah. So it was just funny. But yeah, it surprised me that this cycle is acting so much like the 1970s. So just something to keep an eye on, and we just can't rule out the possibility that the worst of inflation's behind us.
Well said.
Second thing I had was a blog post from Joe Wiggins on behavioralinvestment.com. This was on May 5th, titled How Not to Invest During Times of Uncertainty. So I won't discuss the entire blog, but I just wanted to read a piece on trying to time the market, because I think, before he wrote this blog post, he might have listened to Matt Jessup a couple of times.
Oh, here we go.
On the podcast.
Here we go.
He says, quote, "It seems odd that a reaction to rising market uncertainty is an increasing desire to predict how the market will move, but this is inescapably the case. We have an inherent discomfort with ambiguity, and by investing as if we know the future, it can give us a sense of control. We can't bear to sit and let markets happen to us. To add to this, we are also loss averse. When people talk of market uncertainty, what they really mean is that investors are worried about the chances of losing money, and those are increasing. This is why most market timing behavior is attempt to get out of risky assets before a major fall and then get back in at just the right time. Trying to invest in such a fashion is a sure route to bad outcomes. Not only is the chance of us getting the initial timing correct incredibly low, but even if we are right, we then need to keep making similar decisions, getting in and getting back out again. And what about next time? Do we try to repeat the trick every time we feel markets are at a precarious point? We have an incredibly strong instinct to act and to do stuff. Don't just sit there. Markets are moving. For investors, that often means trying to make predictions about what happens next. While the urge to do this can feel irresistible, it flies in the face of evidence about what it's likely to work for us over time. Thoughts?
Well articulated. Well articulated. I think when we just look at human psychology combined with how fast information flows, it's going to increase volatility. There's this made up utopia perception that people can time these movements perfectly, and these financial news media will hand select the ones that got it right. That's the minority. They project that that's the norm, and when you're not in that group, you feel like, well, next time I'm going to do it. And the most success we see is time in the market, not timing the market. And I'm going to charge for this TED Talk.
Yeah. I think that there's this perception out there that you could use a couple indicators that will tell you when to get in and when to get out, and it's not that hard to do. And markets have a funny way of humbling you really quickly. And just because maybe a couple indicators have worked the past 5 or 10 times they've fired,
keep going,
doesn't mean it's going to work into the future. And we see this over and over and over again, that there is no black box that is going to tell you exactly when to get in and exactly when to get out. So this is something that I think is a very, very hard thing to do for most of us, especially in this country, is just sit on our hands. But a lot of the times that's the best decision to make.
Here's my really hot take, if you want to go down the road even further.
Sure.
Generally speaking, the more that people invest in a similar way, doing something different presents a lot more opportunities. And I know I'm saying that very simplistic to begin. So let's talk about some of the themes that are happening right now in the market the past couple of decades. Passive investing has become more popular, right? And then as of late, more computer-driven trading. The issues with these factors is as more money follows specific strategies, you're eliminating a lot of the advantage that they had previously. And what I'm getting to is, and this is going to sound self-serving, and then I'm talking my own book, but I truly believe in what I'm about to say. I really feel that we are getting more and more into an active managers market. There's not a lot of them out there, and the more that people are huddling into similar strategies, I truly feel it is going to continue to create tremendous opportunities for active managers.
Yeah, I think the past couple of months have been a perfect example of that. And really, tech has been, I believe, don't quote me on this, the only sector that's outperformed the S&P 500 over the past 2 months, I want to say. Mm-hmm. And what's the reason for that? Semiconductors. Semiconductors have been on fire since the market bottom in, what was it, April or March or whatever?
March 30th, 31st-ish.
And if you haven't owned those names, you're probably not doing as well, right?
Correct.
And your account probably hasn't recovered as quickly as other accounts that have exposure to tech and specifically semiconductors. And that's one of the benefits of being an active manager. So.
Yeah. I'm glad you picked that piece.
Yeah.
That was a good one, Mark.
Last thing I had was a post on X from Rob Anderson, who's a CFA. This was on May 4th. Jenna will throw this chart up on the YouTube video and in our show notes. So he says, along with renewed strength from technology, weakness from financials and healthcare have been reestablished since the start of the war. Healthcare's weight in the S&P 500 is now the lowest since 1994, while financials is the lowest since 2009. Tech is less than 1% below its record high. Not a whole lot more to add here, Matt. I just thought it was interesting. And to me, I kind of like look at this as like a stock that's overvalued or undervalued, or people perceive them to be. So when people hear this and they're like, financials and healthcare are at some of the lowest weights they've been in over a decade in the S&P 500.
Yep.
I think initially most people's first reaction is, well, they're undervalued, so we should be buying that.
Keep going.
And if you look at this chart, it's kind of been a steady trend lower for especially healthcare, but financials too. And just because these sectors are becoming a smaller and smaller percentage of the S&P 500 doesn't automatically mean you should be going out and buying those.
Correct.
I'm not saying they can't, jump up in percentage of the S&P going forward, but it's not an automatic buy signal. And I think, healthcare has been beaten down for so long for a reason, right?
Yeah.
There's a reason why people aren't buying and holding these companies like they once used to. It's just been a heavy growth, techie oriented environment for nearly 2 decades now.
I think investors are going out there and they're looking for companies with strong balance sheets with above average earnings growth. And for the most part, you're not going to find it in the sectors that you mentioned. And it's not that they're bad companies, but money has a good way of seeking out good places to make home. And at the end of the day, investors are looking for companies that are growing earnings above the average. Now, you will have rotations, and you talk about this quite often. Sector rotations are the lifeblood of what, Mark?
The market.
And when you look at the rest of the year, tech has been on fire the last couple of months. So what's going to happen is at some point here in the near future, 0 to 6 months, it's a very generic statement, tech's going to go through a rough patch. And just as you indicated, let's just take healthcare as a hypothetical example. It could come back into vogue, right? It's the temporary, value at that point. And then the issue is that's happened countless times over the past decade. And eventually investors wake up in the next earnings season and realize, oh yeah, that tech company is growing earnings at double, triple what this healthcare name is. I think I'll go back into that.
Yeah.
And that's in a very simplistic example, but it gives our listeners and viewers, like, why is that happening? And very simplistically, that's why.
Yeah. Agreed. Couldn't agree more. So I will turn it over to you. We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
All right, great piece to start off with. This is from Lance Roberts, Mark, on May 20th. This is what Lance said. He goes, there's been a lot of hand-wringing as of late, suggesting that higher U.S. bond yields are the death knell to the market. Two things. There's no fixed relationships between bond yields and equity returns. I want to say it again for those in the back who are holding popcorn and peanuts. There is no fixed relationship between bond yields and equity returns. Their correlation changes over time, driven by inflation dynamics, rate expectations, and shifts in credit risk. How well was that articulated, Mark?
It was great, and I'm going to pull something else up here really quickly to back that up and just give listeners a couple periods where we have been in a rising rate environment and stocks have continued to do well, because I came across that.
And listeners, this
recently.
is an important topic. Because if Mark McEvily is correct about this potential scenario, which I 100% agree with him that this is a potential outcome, you will see financial headlines. They will cherry pick the cats that are very much against this, who feel that stock prices cannot do well in these types of interest rate environments. And they're going to put them on the articles that are front pages on these financial sites, and they're going to put them on the financial news media.
Yeah. So a couple examples. So again, this is just me really quickly looking at the chart. So it's not going to be perfect, but from, let's say, mid 2012 until the beginning of 2014, 10-year yield was rising and stocks were up 53%, S&P 500 that is. Roughly late 2016 to the end of 2018, 10-year yield was rising, stocks were up, S&P 28%. 2020 through 2024-ish, 10-year yield was rising. S&P 500 was up 52%. So, it hasn't really been in the not too recent past where we've seen this happen. So I don't see a reason why this can't continue to happen. Now, I think what we were talking about earlier is it might cause some sector rotation. I think there's some other sectors that could be better performers during a higher rate environment, but by no means does a higher 10-year yield mean that stocks have to crash.
Well said. His second point that Lance had, Mark, is, quote, yields have normalized from the abnormally low levels of the pandemic, and a 4 to 5% debt service remains very manageable given the earnings and profit margins we have seen as of late. Now, Jenna's going to put up this chart for our YouTube viewers. This chart will be in our show notes on all of our major social media sites for Jessup Wealth Management, sites like LinkedIn, Facebook, X, etc. And what you're seeing is the underlying source on this is Robert Schiller and Goldman Sachs Investment Research. And what it shows, Mark, is the median annual S&P 500 total returns based upon where nominal 10-year U.S. Treasury yields are. So I'm gonna give that to you direct. It's showing, in essence, the returns based upon different rate environments. And it's very interesting to me that in these higher environments, it's not bad. It's not bad at all. Your thoughts?
Yeah, I mean, if you look at this, when the yield on the 10-year is between 6 and 7%, the median annual S&P 500 return is 19%, which I don't think is very bad.
No, I mean,
when the yield's greater than 8%, the median returns in stocks is 19%. So, I think it's pretty clear that there is no positive correlation between stock prices and yields. Of course,
it could look that way.
Of course, we could have a bad year, but looking back at the data, it's not very clear that this is going to be indicative of a weak time for stocks moving forward.
Well said. I'll continue. So, second item, trucking rates. I talked about this on the podcast. I feel like I'm one of the rare people right now who are talking about this topic. So, trucking rates are high, and here's my point. This is going to impact the cost of goods in the inflation data, because when we go to the grocery store, everything that you were picking up and putting into your shopping cart was transported on diesel. That's a fact, Jack. Yep. And so when you look at the cost per mile, we're averaging $3.50 on average to move goods right now in the U.S. And to give you a comparison, it tends to kind of be in the low to mid twos. Now, these things have delayed effects. So I'm going to be forecasting a couple of scenarios. And one of those could be oil stays high and starts to go down into the midterms. That would be what the incumbent party would want. And let's assume that happens. I feel there will be a delayed effect in prices at, say, the grocery store, to where prices, I think, could continue to go up, reflecting this higher transportation cost. And then as oil comes down, it could take several months than for the prices at the grocery store to follow. And the same thing happened after 2022 with inflation. And the point I'm making is you will see some higher pass-through in these higher oil prices. To move goods right now, it is very expensive.
Yeah. Yep.
All right.
Yeah, I think, you kind of brought up the point when we had a team meeting the other day about, why gas prices were so high in the Midwest, and it had to do with trucking, which I thought was very interesting because, usually I'm being from the East Coast, usually 100% of the time, gas prices there are way more expensive than they are here.
Correct,
but,
sir.
It's really not the case right now.
It's not. And if you actually look at trucking on more of a regional level throughout the U.S., the highest cost per mile to hire a trucker is in the Midwest right now. It is crazy to look at this data. But this is a relative statement. But if we were to slice and dice regions of the United States of America, the hot region right now, hands down, is the Midwest in economic activity. And you know what? Being in Ohio, I love it.
Yeah, it's great.
All right. So the last point, and this is going to be very interesting for me to discuss, and I can't wait to see what your thoughts are on this. I've talked about this index in the past over the years for our regular podcast listeners. This is a survey of the National Association of Active Investment Managers. And if you're curious, listeners and viewers, you can go to www.naaim.org. And this data is all free. You don't have to sign in and create an account. The data set goes back decades, very public, very easy to access. The range of responses, Mark, is anywhere from 0 to positive 200. 0 is you have no stock exposure. 100 would mean that the average active manager is 100% stock, no cash. If you go above 100, you're borrowing money, you're leveraging. And if you go below 0, negative, you are then shorting the market, okay? So the theory here behind this historically, why people will take a peek at this, Mark, is it gives a sense of how much dry powder is left out there for active managers. And when they tend to be close to that 100 mark, it might sense that the market might be near a midterm top or a short-term top. Why? Not a lot of cash left to pump up the prices. Supply and demand. Here's the interesting part. The data set from May 6th, it's every week, showed an index number of 96.67, meaning the average manager only had about 3.5% cash, tongue in cheek. Mm-hmm. And when the survey came out May 13th, that figure dropped tremendously to 77.34. Huge drop week over week. But guess what? The stock market didn't drop anywhere near that percentage. And this kind of intertwines and goes back to our conversation about the herd mentalities in the market. And when you would normally see such a drop, man, that I think you got to pay attention. What's your thoughts when you see the stock market not really getting affected and active managers taking some risk off the table?
Yeah, and there could be a million different reasons as to why this happened. It's either, these larger money managers see something out there that is making them nervous. It's them taking chips off the table from the strong recovery since the end of March. I don't know, but obviously it hasn't affected
the
stocks
market
yet, right? So I think it's another good example that the big money managers aren't necessarily right 100% of the time.
Sure.
And even, these institutional money managers can get spooked from now and then.
Yeah.
But yeah, it's interesting that we don't usually see that big of a drop in exposure to stocks without a corresponding pullback.
Well said.
And I think, another thing that I saw yesterday was, we're, as of yesterday, I think before the market opened yesterday on May 20th, we were about 2.2% below the all-time high set just a few trading days ago, right?
Yes.
And usually when you get a pullback in stocks, you get a little bit of a spike in volatility, or the VIX index.
Correct.
And what's interesting about this mini little pullback that we've gotten so far is volatility really hasn't ticked up a lot at all. So reading this data made me think of that's just kind of interesting to me that, the sell-off hasn't been stronger, I guess, than it is.
I think it goes to show you that for many, many years, the public stock market, the public equity markets, and I'm saying this in comparison to private equity, has not been a loved asset class, just in general. And I feel like stocks have been carrying this volatility, discount that's been associated with them. But guess what? There's something to be said about an asset class that has daily liquidity, and private equity is finding that out the hard way. Secondarily, the balance sheets, the stock buybacks, the earnings growth. And I think all of a sudden, the stock market and the public markets are starting to get not the respect they deserve, but more respect than they have received in quite a long time.
Mm-hmm. Yeah, simple is good. Simple, I think, a lot of times has a negative connotation with, dumb or not smart enough to be involved in these hedge fund strategies and illiquid market strategies. But simple a lot of the times wins in the long run.
It's well said. Before we invite the one and only Taylor Ledbetter to talk about the financial planning topic of the week, I know she's got a great topic here for listeners and viewers. I saw in the notes that she's going to talk about new Trump IRA accounts. Before you step away, Mark, any other thoughts you have for listeners and viewers?
No, I don't think so. We're kind of at the tail end of earnings season here, so really hasn't been too volatile of an earnings season. Obviously, not to the downside. I think earnings surprised a lot of people and brought the market and investor focus back to what drives stock prices, at least for the time being. So nothing else right now. Obviously, we have a new Fed chair. Typically, when you get a new Fed chair, performance isn't great shortly after that.
That's correct.
So, again, wouldn't surprise me if there was an increase or a pickup in volatility and a little bit of selling over the next couple of weeks or couple of months. But again, it's been a pretty strong V-shaped recovery. So even with or without a new Fed chair, you got to expect some consolidation or a little bit of selling in the not too distant future.
Well said, and this is exactly why you listen to the Independent Advisors Podcast. Well said, Mark.
Thanks, everyone.
All right, we're going to have Taylor onto the podcast. We do a financial planning segment on a regular basis here on the Independent Advisors Podcast. Taylor Ledbetter handles all of the financial planning work behind the scenes for Jessup Wealth Management clients. Taylor, welcome to the podcast.
Yeah, it's good to be back.
I was intrigued by the topic. Obviously, I think a lot of our listeners and viewers have heard snippets of these quote-unquote new Trump IRA accounts. Mm-hmm. But I don't think up until recently there's been a lot of detail. So what you're about to discuss will be new for me as well as our listeners and viewers. So without further ado, I'll turn it over to you.
Yeah, so all of this information I'm about to go over does come directly from the White House's website.
Got it.
And this is really new because Trump signed this executive order on April 30th this year.
Very fresh.
Yes. So the purpose of these new Trump IRA accounts are just to increase access for individuals who maybe don't have a plan through work, or maybe they don't receive matching contributions through work. So a lot of employers have 401ks is kind of an example.
Yeah, and I'm saying this from a bipartisan statement. I think this is a great thing. I really do. And you haven't gone deeper yet, but I'm looking forward to kind of seeing where the details are And as you kind of go over them, I would love to kind of respond, and I'll kind of give you my 2 cents. So
Yeah.
continue. It's going to be fun.
Yeah, so some examples of who this account would really be targeted for would be people like independent contractors, part-time workers who maybe aren't eligible for their employer plan
Yep.
because they're not full-time,
Yep.
small business employees, and then of course self-employed individuals. So right now, there's roughly 41 million American workers between the ages of 18 and 65
Yes.
that don't have any access to an employer-provided retirement plan. And there's roughly 49 million full-time and 14 million part-time workers who don't even receive matching contributions. It's a pretty large portion.
It's a big portion, Taylor.
So what makes these Trump IRA accounts different from regular traditional IRAs is that these Trump IRA accounts will receive a match from the federal government.
That's a big deal.
Yeah, I mean, anybody, as long as you have earned income, anybody can open up a traditional IRA, but of course you don't receive matching contributions on that.
Yes.
So the matching program, it's going to be called the Federal Savers Match Program.
Okay.
And basically the government is going to match 50% on the first $2,000 of your contributions annually.
That's tremendous.
Yeah, that makes a big difference.
So if we, have an individual that is, willing to make that sacrifice and save $2,000, here's the way that I like to frame it. Even if you sit it in the money market or whatever the most conservative investment option is, in year one, you got yourself a 50% rate of return on that $2,000 contribution
Yeah.
with the match. If you view it through that lens, where else are you going to get a 50% rate of return?
Not in a money market or
Not in a money
CD.
market.
Yeah.
And I know that's kind of a slanted way to look at it, but that's a way to get people motivated to start the process. And once they start that process, they tend to continue it. Continue, Taylor.
Yeah. Yeah, and with this account, there are going to be phase-out ranges based on an individual's MAGI or modified adjusted gross income. So if you are a single filer, that phase-out is $20,500 to $35,500.
Okay.
If you are an HOH filer, it is $30,750 to $53,250. And then if you are married filing joint, that phase out is 41 grand to 71 grand.
Got it.
So this means if your income exceeds these amounts, you're not eligible to contribute or participate in this account.
My initial reaction is anytime there's policy on different topics, you tend to have the discussion of what we call the donut hole, which are individuals that kind of just get missed for whatever reason and topic we're on. And I could argue the target demographic on this specific topic have been in the donut hole, right? They really haven't had access. They obviously haven't had a match in the target market you're discussing, as well as the income ranges. I think it's a good design to try to target those that haven't had this exposure before.
Yeah. I wonder what percentage of the population, or I guess working Americans, this is really going to affect.
It would be neat to kind of, it'll take time, but it'd be neat to kind of look back in 5 or 10 years and see who benefited from this, right? What percentage, when they started, did they continue to contribute? I would be just fascinated to see what this looks like down the road.
Yeah, I'm sure we will have data come out at some point about that.
Absolutely.
So other than those income thresholds I just mentioned, there's really only a few other requirements to participate in this account. So you have to be at least 18 years old.
Okay.
You cannot be claimed as a dependent on another person's return.
That makes sense. Otherwise, there would be a bunch of children who would be taking full advantage of the 50% match up to 2,000, right?
Right. And you cannot be a full-time student. So those are the only requirements as of right now. not a ton of information has come out about this yet. I'm assuming it's going to be very similar to just a regular IRA account, contribution limit wise and penalty wise, keeping funds in there till 59 and a half. That's my assumption as of right now.
Yeah.
But from my knowledge, nothing has been specifically said about those specific details.
Yeah, I'd be curious. The first thing that comes to mind, Taylor, is I'm assuming it's 100% vested in the year it goes in. I think about, someone who's saving into this and all of a sudden wants to make a move from renting to buying a home, and they need to come up with money for that down payment. Makes me ask the question, all right, I want to make sure that this match money they're getting, are they going to be able to access that? Even if they have to make it a taxable event, and I'll just kind of leave that there, are they going to be able to access that? It sounds like those details are not necessarily there yet.
Correct.
Right?
Yes. And this account, it's supposed to be fully operational by January 1st of 2027. So really not that far away.
No, it's not. My 2 cents is I am intrigued by the creativity that this is trying to address, and I welcome no matter what party is in office, and I say that because it has the word Trump in the name, right? And I want to be careful. And I don't care who's in office. I welcome continued innovation on ways to encourage individuals to be saving. And this is just another way that's targeting a certain demographic that I'm all for it. Just want to throw that out there.
Yep. From the matching contributions alone and just what we know so far, I think it sounds like a better option than just a traditional IRA.
Yeah.
And I'm sure, too, the investment fund options are going to be somewhat limited.
Yes.
But I do know that the funds that will be offered do have to have a low administration cost of no more than 0.15%. So that's another perk.
Yeah, my guess is it's going to look and feel like the TSP or the thrift savings plan that is available to government workers. I bet you, if I were kind of speculating, they're going to try to piggyback off of that system to administer this. I'm speculating.
Yeah.
But I have a feeling it's going to look and feel like the TSP. Very simplistic options. The C fund, which is the common stock fund, also kind of loosely known as the S&P 500 index. The S fund, the small cap fund, loosely against the Russell 2000 as an example. I have a feeling it's going to be somewhat like that, but as you indicated, we got to wait for the full details to come out.
Right.
And when they are, I know you'll come back on the podcast and convey that.
Yeah, I mean, I'll definitely talk about this again before we get to that January 1st mark.
Yeah.
Because, again, there's just some details that I would like to know more about, and we can convey that on the podcast.
Great job, Taylor. I want to reiterate to our listeners and viewers, even if you're not an active Jessup Wealth Management client, feel free to reach out to Taylor with questions. You might have a question that is insightful, and she can make it a topic on a future podcast. So thank you, Taylor.
Yeah, you're welcome.
We will leave it there for the episode here, 351 of the Independent Advisors podcast. Catch us next week for episode 352. We have a special guest on next week's podcast. It's going to be Chris Kirschner. He's the CEO of the Dayton Chamber of Commerce. I'm excited to have him on the podcast, and we'll see you then, everyone.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.